I hope everybody is looking forward to this exciting session of how to attract private capital, private equity and venture capital into medium and small businesses. Last week I was in Singapore and one fund manager, a global fund manager, made a presentation and showing that out of the $90 trillion of a global economy and the number of people that are employed in the global economy, largest part is contributed by medium and small businesses. And he was presenting a case as to how to bring capital to these small, medium businesses and how to open up that aspect of these high growth businesses from them to be funded. And amazingly, his proposal was how to build a community of successful MSMEs, put their capital together and invest in the businesses, and he was putting a complete format for that. The important thing for me to share here is, and after listening that pitch, I received this invitation from the finance team from CII that they want me to moderate this particular panel on private capital for MSME. I'm really delighted to be here and to moderate such a distinguished panel, very diverse set of experiences that you'll get to hear. And I've been given a very, very tough task to clarify the myths around venture capital or private equity and how to go about raising that capital. Hopefully, we are able to do justice to both these aspects or so. Before that, I would like a quick introduction. I'm Sunil Goyal. I run Your Nest Venture Capital. I'm hungry to find high growth businesses that can go global from India. Over to you, Manu. Over to you, Mohit.
Hi, I'm Mohit Dhawan. I manage the investment business for Hero Enterprise. We invest in mid to growth stage companies, typically in consumer businesses, healthcare businesses, financial services, and technology-enabled manufacturing or logistics businesses.
Hi, I'm Manu. I run SOS, which is a very early stage venture capital fund that invests in consumer businesses. So we like to invest in personal care, food and beverages, pet care, consumer health, those kind of deals. And in the MSME, I think we focus on the really small, the really small S part of the spectrum in terms of stage. Thank you.
Hi, I'm Prashant Narang, and I run a fund called Agility Ventures. So we're an angel fund focused on early stage companies, pre-Series A, and we have been supporting these startups primarily, early stage startups in this space.
Thanks, Sunil. My name is Vinay. I run a fund called Fireside Ventures. We focus on consumer brands and early stage consumer brands at that.
So good to see the panelists who have been investing in small scale brands, businesses across domains. So hopefully you'll pick the knowledge from there. Whenever I've talked to a small business owner and asked him whether you'll be interested in taking private capital, the first fear that comes out is, I don't want to lose the control of my business. Is this a real myth? Is it the truth? I would like, Mohit to throw some light onto this one. Do we really lose control of your business once you take a private capital?
At a broad level, Sunil, it's a myth because most VCs look for passionate entrepreneurs with the ability to solve problems and a strong second layer within the team to help the founders. And most VCs don't want to run the business. The broad mandate is that we are strong cheerleaders for businesses, bring our network and connections to bear for the companies, bring our experience in problem solving with similar businesses, and improved corporate governance standards. So some VCs may bring operating partners into companies whose role typically is to assist the entrepreneur assist the founder with all of the above and bring their domain-specific knowledge. But unless the business is seriously gone wrong, and even in those situations, most fund managers, most venture capital investors, private equity investors, their mandate doesn't allow them to be operationally overbearing or controlling in the business. So while any investor will want to safeguard their capital, most investors don't want to, and frankly don't have the bandwidth to be operationally overbearing or take control of the business. So I think at a broad level, uh, MSME founders should take comfort that VCs are our cheerleaders or private equity investors are our cheerleaders and supporters and not necessarily want to take operating control of the business.
So, very, very good point. Structurally, private equity teams are very, very small team of 4 or 5 partners, very small set of people. They are not designed to run and operate your businesses. So even if it is mentioned in the term sheet or so, in case things go wrong, they would like to, sell the business or something like this. The good part is they are giving you, they are not structured to take control of your business.
One more thing I wanted to add, most VC fund managers come with a strong operating background. They have the operating background to be able to assist you, but the last thing they want to do is take control of the business.
Yeah, otherwise we wouldn't be in the business of investing. We would be a CEO of some business and running that business alongside you. So that's the core aspect of it. There is a second aspect which, Prashant, I would like you to clarify. This is about, every investor wants to invest in a business for a period of 5 to 7 years. And if you are not able to give the exit to that particular investor, that investor normally will have a right which is called a drag along right. Now, what is a drag along right? That right is that if the investor is not provided an exit for his business, then the entire business of yours can be sold to a third investor or a third strategic partner or so. So, Prashant, can you clarify as to how does one deal with such a situation?
So I would say that the drag-along rights that are given, that are taken by the investors are more like a safety net, because they are putting their money into your business and you are running the business. Now, the situation, if the situation arises, where the business is not doing well, then only there would be a need for the investor to, find a buyer for the business. But I would say that in case if the business is not doing good, finding a buyer also becomes a little difficult. I was in another panel yesterday, and there were funds who were investing in late-stage companies. So all the panelists who were running these late-stage funds, they said that if there is a case where we have the drag-along rights also, but in case if there is a situation where the company is not doing well, we would pump in more capital to support the company, to keep it running, and give all kind of support that the company requires, both in terms of connections, both in terms of guidance, and maybe mentorship that is required at that stage. We're going to come out of that situation rather than taking the company and to another buyer. So maybe there is a infusion of a capital at a lower valuation, which is called a down round, but the purpose is to keep the company afloat. So one is that there is no intention for the investor to take you and to a seller, to a buyer and sell your business. It is about they are putting their money. In fact, venture capitalists are putting others' money into your business, so they need that safety net. So in practical sense, it is just to safeguard their interest. But if you have a plan to give them a good exit, if you have a proper plan and you do that, they are happier taking that exit rather than taking the drag along route. So I would say that we all run businesses. We are all very optimistic people. We try to build our businesses and take that to the next level. The only thing that when we are taking venture capital, we should have a definitive plan to give an exit to the people who are putting in the money at any stage. So that is what I can say.
Very well, Prashant. We put in money in a founder after seeing the capability of that founder. There is no reason for us to sell your business to third party who thinking that that person will be able to run the business better than you. It is you who have to run it, continue to run it. The good part is most of the time it will be going well. If you're going well, you just give an exit to the investor. If he's not doing well, build a relationship like that the person still, the venture capitalist or the private equity guy continues to support you. Now let me come to another aspect of it. Let's say there is a venture capital money available to you. Should you take it? You know, isn't the debt money, debt capital, debt financing much, much cheaper than equity funding? Why would I come and invest in your business? I will come and invest in your business only if in the next 5 to 7 years you can multiply my money 20 times. So in a scenario like this, should you be taking our money? Maybe, Manu, you can highlight with your experiences of investing in so many startups.
Yeah, thanks. It's a good question, and I think it's always a decision of how you structure your balance sheet, and that answer really comes from two things. I think firstly, what is the scale of ambition and growth that the promoter of the MSME business has, right, for the business. So if you're really looking at this as a fairly sustainable, even though it's a lower growth business and you want to run it as such while protecting your ownership, then debt is probably the right answer for you. But mind you, debt is returnable capital, right? It comes with several strings attached, right? And you should be very clear that the cash flows from your business should be able to serve that debt and its requirements and its covenants, right? Venture capital or private equity for that matter is far more permanent, far more long-term, right? And should be seen as more as partnership rather than just purely sort of fitting in a capital requirement gap, right? So why and when should a promoter go to a VC or a PE is when they're looking for much more than just equity capital, right?
Yeah.
So if you get, folks like, Fireside, for instance, or Mohit, etc. on your cap table, you're not just getting their money, right? These are folks who built businesses to serious scale and have all that experience, all those networks, etc., which also come into play, right? And their partnership is far more long-term than the kind of debt that would come into play for a medium to small scale enterprise. So it's a bit of capital allocation as well as strategically looking at what you really how you're imagining your business to be in 5 years.
Very nicely put. When you take money from a partner as private equity, venture capital, it's not just the money, it is the wisdom, experience of those people that is coming along for you to grow your business faster. And you don't have to worry about returning the capital. You have to only build your business and scale it up so that somebody else can come and buy that particular stake. There is another aspect. When I talk to small businesses, they are so attached to their brand. The brand, the trademark, the copyright, they feel that they build that particular brand for lifetime, they build that for generations. They don't want that brand to actually be transferred in the company's name. Normally, these copyrights and trademarks are owned in the name of the founder. Is that a good practice? Vinay, you've been investing in brands, so maybe you can throw some light as to how do you overcome that situation?
Maybe you should have got a lawyer to come on this panel. They would have been more educated than me, but I'll take a stab at it. I think in most businesses, and especially consumer-facing businesses, the brand is the key asset that builds long-term value in the company. There is obviously the revenues, the P&L, the good cash flows that most consumer businesses build. But if you look at what is predictable, repeatable, and has long-term value, it is the resonance that the brand has with the consumer, or the consumer has with the brand, and therefore they keep coming back and repeat purchasing with the company again, and that's what's valuable. And therefore, if the key asset of the business is sitting outside the business, then for any external investor, the business then becomes a trading business. And the investor will look at it with trading multiples in mind and not brand multiples in mind. And this could be an order of multiple difference, which could be a 1x to maybe a 5x of that. And that's where I think then the question of dilution, etc., is something that needs to be considered. Given that, especially VCs, and I can talk for VCs with a little more authority than PEs, but we are coming in at an early stage. There are a lot of risks in the business. This is one risk we wouldn't want to take. And we would like the business to have all the key assets in the business itself, rather than it being sitting outside the business with no control of where the value creation is really happening.
Yes, and if you go to a lawyer, and maybe 20 years ago you would have gone to a lawyer would have definitely said, you keep your brand separate from the business, so that you can sometimes earn royalty, as some of the brands have earned royalty from their brands from the business tomorrow. Please don't do that. The times have changed. Times have changed. You know, these were some of the myths that we wanted to clarify as panelists. Please think through your question. We will take at least one question around myths from you in another 10 minutes time. And if you want to clarify something from these experienced panelists, please come back to me and raise your hands in 10 minutes when we come back after going through the second part of the thing. How about raising capital? How to pitch? How to develop skill to be able to attract the attention of a private equity person? And here, I would again like to start with Mohit. You know, Mohit has been the investor as a group in some of the largest high scalable businesses, from a beauty and a e-commerce business of Nykaa, from a jewelry store of Bluestone, from a, the student renting place called University Living, etc. What is the advice, Mohit, that you will give to these small businesses as to how should they come and pitch for a private capital?
Sunil, there is no science to it. I guess all my years of experience, I've been able to understand something very simple. Good ideas and good people get funded. And ultimately, VCs are also human beings. When we hear you talk, if you are able to relay the proposition in a simple, straightforward way, people relate to it and it gets funded. Structurally, what we look for in a business, we look for differentiated, defensible proposition in a business. Something that has a moat around it. It's not that tomorrow the next guy starts a business and you get taken out of the market. Operationally, we look for good margin profile, clear paths to profitability, depending on the scale that you're in. This is a 20 crore business. I don't expect to be profitable. But a 200 crore business, at least there is line of sight of profitability into business. Then we look for promoters and management teams, right? Strong, passionate entrepreneur, founder with a management, the next layer of management bench strength in it. And lastly, good quality corporate governance. Now, this is very, very important. Most people don't really pay attention to having a good quality board or having your board meetings in a timely manner, filing your statutory dues in a timely manner. These are small things, but people really miss them sometimes. And lastly, the last thing a VC or an investor wants to see is any kind of funny business in the numbers. So if you're mindful of these things, and a business has a good, strong growth trajectory, profitability, margin expectations, anybody would be at least you would find one or two investors that would be willing to put capital into a business like that.
And the most important message is there is no science to pitching. If you can be yourself, you believe in your business, go tell the story with the belief that you have, and somebody will come forward to listen to it. And on the hygiene side, please ensure that all the compliances are in place. Manu, on that note, I want to come to you. Just extending that thought, how to bring, build that trust around private capital, how the ecosystem of private capital can grow. Some thoughts around it. Let's say all these ingredients that Mohit mentioned are there?
Yeah, I think, you know, like Mohit mentioned, venture capital and private equity is run by human beings. And beyond, it being a financial transaction, it's also establishing a relationship between the principals, right? So if you want to build trust like in any other relationship, it has to be on honesty and integrity, right? And transparency. So I need to be absolutely on the same page as you on every aspect of the business. It is a very, very long-term partnership, almost akin to a marriage, right? So before we get into it, there is a period of dating, and I think it's important that we're very clear and transparent about everything during the period of dating, and then like Shadi mein, the families do their ref checks. We do our due diligence, and all of these good things that Moy talked about in terms of governance is very important. And I think we've come a long way in the MSME sector in terms of governance, et cetera, and certainly from 10 years back, right? Companies have shaped up. They do understand the importance of following the law in spirit as well as to the letter, but we still have areas for improvement. And I think as the ecosystem keeps maturing and more institutional investors invest into this segment, it is our role as investors also to inculcate these habits from an early stage, because it's always tougher to kind of correct these mistakes later on. So getting these best practices in, having the right amount of transparency, communicating at regular intervals, not when things have really gone bad. Those are just simple one-on-one things that everyone should do. It takes consistency to do that, but that's what really builds trust. The right small steps consistently being done and communicated, it helps investors and all the stakeholders, right, to build trust.
No.
If I may add,
Yeah.
One of the things that I want to highlight that sometimes I've seen founders say कि ये बाहर वाले आदमी को मेरे business के बारे में मेरे से ज़्यादा कैसे पता होगा? See, most VCs, most investors get to that VC role or investing role is because they've had strong operating experience in their past. And even as an investor, you tend to see, on average, nothing short of 5-7 businesses a week. And businesses that you're invested in, you're fairly deeply involved and engaged. So more often than not, a good quality investor would come with a lot of experience of having seen diverse businesses across diverse sectors. So there's certainly a lot of knowledge, experience, and network connections that person can bring to your business. And the last thing we should do is not be able to take advantage of those.
Very well, and Manu shared the thing of making it a habit of transparency. And I'm going through a very tough time right now. Why a tough time right now? Around 4 months ago, we started meeting one startup, doing 10 crores of rupees revenue. We loved the business. We loved the founder, came with lots of recommendations or so. And we found a co-investor also, who also loved the founder. And now we completed the due diligence of the business. After the due diligence, it comes out that 10 crore revenue business has payables to the government of around 1.5 crores, loans of 3.5 crores, now 5 crores of outstanding for such a small business. What we did, we went back to all the recordings of 5 partners, all the meetings, all the notes. Did that particular founder make a statement somewhere and hinted to us that there is a loan in the books? No, nowhere. Yesterday morning, I had a call with the co-founder, with the co-investor who was leading. From our side, it is a no till the time the person can come and justify his stance that why he did so, in case he did so. So please be very, very transparent whenever you're dealing with a private equity venture capital. For us, anything like this coming in as a surprise is no. Surprise, which is a good surprise, also is bad for us. So that's the thing. We don't like surprises in our business when you're pitching to us. On that, Prashant, what do you think? You were in a panel with the chartered accountants yesterday. What do you think are the risks and challenges for a MSME to seek funding from private capital?
So I would say there is no risk as such to take money from a venture capital, but the challenges that I see, and that what we were discussing yesterday, I was in another panel. It was so the discussion was why SMEs are not able to get money from the venture capital. What is that stops them, and what is that the PVC investors find it difficult to invest in the SMEs. So the foremost is, I believe, and I've been dealing with a lot of SMEs, so it's through the personal interaction. So one thing that I find which is very common is the love for the equity, the ownership of your enterprise. That 100% it is mine. That mindset has to be it has to be changed. That when you are giving part of your enterprise to somebody as the investor, what you are getting in return. So when you take loan from a bank does not support you in a day-to-day functioning. But as the panel has already mentioned multiple times, the kind of value that a VC brings in. But I feel people are so attached to the ownership of their organizations. The only I would say shift that is required is that, and I tell this to people, it is better to own 50% of a 100 crore business than to own 10%, 100% of a 10 crore business. So you have to understand what scales you can achieve with the help of the venture capital. So the one is that mindset that stops people from going to these investors. Second is definitely, again, which has been mentioned earlier, the corporate governance and the the financial reporting that we do. So for all SMEs, primarily the financial reporting is more tax driven in our country. We want to pay this much of tax, and so those practices really make investors uncomfortable. I mean, I as an investor would not invest in any business which is into any kind of those malpractices. SMEs have to understand the everybody's talking about 1x, 5x, 10x of the revenues or the profitability that your enterprise is reporting is generating. But if you're reporting, say, only 10% of that, maybe you have saved a lot of tax, but the value that has got eroded, that is tremendous. But which SMEs don't relate to. Again, you have to start thinking from that perspective. Lastly, I would say that all the investors here would agree they want to invest in futuristic businesses. Innovation, disruption, these are things which we really think about, but we are really not doing anything about it in our businesses. Or we are not tweaking our businesses to match to this change that is coming in. So when you are running a business which is traditional, this might not be as lucrative as the modern day businesses for the venture capital. So think about how you can bring in innovation and technology into your businesses. And I have been advising people that if you're in a business which doesn't seem to be, that it would be in existence in the next 5 years, then it is time that you really change your business also, if it is required. So those are the three things that I could think of immediately.
Very well, and let me give you some live examples from life, what was shared by Prashant. I worked for Dabur for 10 years in the 1990s. Then I worked for Sunil Mittal for 10 years from 2001. When I walked into Sunil Mittal's office and I saw him raising $500 million within a month of my joining, and we are discussing as to how much company will be diluted because of that capital coming in from Warburg Pincus. And the answer was the same that Prashant gave. And in Dabur, we were sitting on 80% of the ownership with the family. And here comes a founder who says, "Hare, I will grow my business so big that 26% that I own of Bharti Airtel will be far more valuable than the 60 or 70% that currently I own." And he made it happen. From that day, the value of the business was hardly $300 million, but that capital, it went up to $1 billion and built this empire of $50 to $60 billion just because he was forthright that he will bring knowledge, talent, and dilute his equity and grow it bigger. So that's point number one. Point number two, if you take out 1 rupee from your business, it is only worth maybe 50 or 60 paisa because the money has not come out in white, it has come out in black. But if that 1 rupee stays in your business, The people like us value it minimum 15 times. And if you own 50% of that business, so that rupee is worth actually 7.5 rupees if a 50% owner of his business ke. Never take out a rupee from your business. Being it in the business is far more valuable. Somebody will give you multiple times more value. Now, many of you are brand businesses out here who run brands, who want to raise capital. And one of the most prolific investor in the brands is Fireside and Vinay. Vinay, how should a brand guy come and pitch to you? What is it that you look forward for you to be able to say, yes, maybe the person is making these bottles only, and he's branding them, he's this thing, or he's making buckets, he's making whatever. How does he come and pitch to you to raise capital?
And I'm sure Manu can add to what I have to say. He's seen many more businesses in the consumer business than I have. But essentially, there are a couple of consumer backwards questions that any investor would like to understand if you're building a consumer brand. One is, who is the TG that you're going after? Why is she or he currently underserved by the current products or options that are there out in the market? How are your product going to be so differentiated, give a functional benefit, a product attribute that will really delight this underserved consumer? How will you reach this consumer? Is she available on the internet? Can you sell on the internet? Is there a unit economic model here that can help you achieve it? Or do you have an alternate distribution channel that you can access this underserved consumer, which doesn't go at crosshairs with the incumbents in the market? Because, you know, when elephants dance, always the mice get killed. So you need to be slightly differentiated in your go-to-market approach. And then, therefore, as a result of all this, where is the consumer love? Is there some evidence that consumers are coming back with good reviews, good ratings, good retention rates? Are they referring their friends and family? And all of this English, does it translate into maths of some good economics, unit economics at a post-all variable cost? And is this revenue scalable in terms of, while sure you're making unit economics today, but is it priced versus the source of growth that enables consumers to at scale upgrade to your offering? So your offering can have great gross margin and contribution margin, but if it's priced 3x of your source of growth, then it's going to be a niche business. But if it's priced at 1.2, 1.3, 1.4x, depending on the category, there is a very large possibility if you build a brand, people will upgrade. So I think these are a couple of questions that we would look for and want to understand in the business. And then obviously lean, as all the panelists said, into the team. And why is it that you and your management team and your co-founding team the best place to take advantage of this gap in the market? What is the passion that you bring to the table, and what is the why do you get up every morning to work an 16-hour day? It's not easy, and we'd like to understand what's driving you.
Very insightful. So, good stuff. Now I am opening it for question answers. Yes, there is a hand out there. Please go ahead. So, mic. If somebody can give a mic there, please. Please run with this mic, yeah. Okay, there is a mic, yeah.
Hi, my name is Ashutosh. I run a SME manufacturing business. I have two quick questions for the panel. First question is that do you think of roll-ups as an effective strategy for mitigation of risk and scaling the SMEs into larger companies? That's one question. And I'm not referring purely to the D2C roll-ups in vogue these days. I'm referring to generally roll-ups as a strategy. Number two, we talked about brands, and primarily I heard a lot about consumer brands. I want to ask you that are industrial brands also of any relevance in terms of being attractive to investors? Because as long as your IRR expectations are met, I think that's fine. So that's the second question.
Who would like to understand, I mean, roll up? Huh? You want? Yeah, please.
I think as long as it makes logical sense, doesn't matter what kind of business you're running. Roll-ups can be either vertical or horizontal, either you're backward or forward integrating.
Just explain roll-ups for everybody, yeah.
Okay, it's essentially an acquisition or a merger depending on the size and scale of the two businesses that are coming together. And typically, roll-ups are referred to as when a larger business takes on a slightly smaller business and integrates the two. Now, it can be vertical or horizontal. Vertical, you can either backward integrate. So since you're manufacturing, maybe you buy out the procurement piece of the your raw material suppliers, or you forward integrate into distribution chains, etc. Or you can horizontally roll up as well, where you are in category A and there's a complementary category which usually gets sold together to the same set of clients, etc. So it makes logical sense for both supply chains to coexist. So as long as there's some kind of synergy in the business where the client is the same, the distribution channel is the same, the back-end supply chain of procurement is the same, and 1 + 1 actually adds to 3, and that synergy can be released by putting the businesses together, doesn't matter. I mean, even in tech, for example, if ultimately the enterprise buying the tech is the same, you can sell a HR tech and let's say a procurement tech to the same admin person, then that could make sense as well. And there are a bunch of SaaS roll-ups as well. So depends on what is the synergy you're seeing in the roll-up, and is that synergy really going to result in cross-pollination of either clients and therefore revenue across the two businesses put together, or is it going to release some margin downstream? Uh, is it that you're going to kind of amortize fixed costs across the two businesses so that the overall EBITDA comes up? Somewhere you'll have to start from the bottom at an EBITDA contribution GM or revenue line item and see where the synergies really kind of line up. But maybe the
Yeah,
next
good,
question
good.
somebody else can.
The second part, maybe, his second part question of Ashutosh was, if it's not a brand business, I'm investing somewhere and the returns are going to be big. Is it attractive?
So I'll take that. So we look at technology-enabled manufacturing businesses, and unless and until there is some sort of innovation in the business that differentiates it from a traditional manufacturing business, which essentially is a relatively lower margin profile, uh, the for an investor, the value accrual really becomes difficult, right? Unless and until we've been able to create some sort of a differentiated proposition in the business that can either help it scale to, either help it, just we've been talking about the roll-up strategy. There is either a revenue synergy or there is a revenue growth from your innovation or a cost saving from your innovation. If that is evident, then it's like any other business for a venture capital. So we are all brand businesses, but at a core, we are opportunistic investors as well. So if you tell, not Vinay, Vinay will probably not go beyond consumer, but any of us, uh, if there is a business that's showing 30% EBITDA level margin, I'd be damned any of us would be looking at it, be it consumer or not.
Fair enough. Any other question, please? Yes, there is a question here.
Hi, this is Arun Gupta. I'm a corporate lawyer by profession, so you're talking about lawyer.
Yeah.
I have a very simple question. Like we talked about governance, compliance. As an investor, do you think that during the DD process, due diligence process, if you find any regulatory lapses or in governance issues, will it lead to deal breaker, you will not invest, or you will try and find out solution? If it is you can find out remedy, you will go ahead. If not, then you will not, as long as it is not affecting the going concern.
Manu, you want to take that?
Yeah, sure. I mean, look, I don't think I have undertaken a due diligence in possibly 15 transactions where there was not a lapse, and I'm sure goes for all of us, right? It's about the significance of the lapse, right? And there's no clear answer to this, but our intention going in is that sure, there will be certain lapses on account of oversight, and also we recognize that the stage of companies that we invest in, right, they necessarily don't have the right resources, understanding, or focus on a lot of these requirements, right? The ingoing idea is not to look at it as a deal block, right? But to figure out a solution and to remedy it and to put in measures such that going forward, these kind of sort of oversights do not recur, right? I would say 90% of the gaps that we do discover on account of oversight are remediable, and the law has several provisions for you to sort of either compound a penalty or, you know, appeal for, you know. So there are ways and means, and typically what we do is, if it's a significant enough error, we want that to be remedied before we invest. So we put in as a condition precedent to our investing. If it's a small enough gap that we can live with, which has a quantifiable risk, then we will take some protection as investors and urge the promoter to rectify it within a reasonable period of time, which can be 2 to 3 quarters or whatever is permitted by law. So that's typically, if we do obviously discover a malfeasance or a fraud or willful thing, then it's an intent issue, exactly. Then it's an absolute red flag. There is no way I think any of the investors will go ahead with that.
Very, very good stuff. Very simple oversights, okay? But the moment intention is seen, we will walk away.
Sunil, can I add to that? So, I mean, so one is definitely, you know, the seriousness of the problem that is there or the remedy that is available or not. I believe it is also the response of the promoter, the founder, to that, you know, that has decided. For us, I would say we come at a very early stage, and I would say the problems are not that big, but the way the founders have responded to those, you know, anomalies which are there, that has also decided. So recently we came out of a deal only because the founder was taking the non-compliance very lightly, you know, and the response that I got was like, I said, if he's not taking this seriously, then I don't know whether I want to invest. So we pulled out at the last moment because of that reason. So, you know, that is also one aspect.
Oh, time is running out, so we will not be able to take more questions. I wanted to take the last piece of advice from each of them, but we don't have the time. But I'll give my piece of advice to you. You know, whenever you're taking money from venture capital, investor, private equity, the one way that you can keep control of your business is to ensure in the board of directors, majority seats are with you. If it is the investors asking 3 board seats, have a 7-member board with the 4 members being representing from your side of the table. That's the way you can keep a control of your business despite 50-60% of the capital being owned by the investors. So that's one way to keep a control. I hope you know, you will enjoy that particular advice and make most of it. Thank you so much for participating and listening to us.